Hello and welcome to our webinar on tax reform. My name is Von Lawrence and I'm the Director of Communications and Technology for PAMIC. As an organization, PAMIC is focused on providing timely education to our members about the issues that directly affect their companies. The recent changes in the tax code will affect each and every one of our member companies, and it's important that we tackle this issue now. Before we begin, I would like to take some time to thank our Premium Gold sponsors for 2018. Their sponsorships allow us to offer high quality education and exclusive benefits to our membership throughout the year. Their support is crucial to the success of our organization and the mutual insurance industry. Those sponsors are Baker Tilly, Donegal, Jen Ree, Guy Carpenter, Markham, Munich Re, Hartford Steam Boiler, Mutual Boiler Re, Pennsylvania and Indiana Lumbermans, Swiss Re, and Willis Re. We got some great presenters for this presentation. They are Carrie Small, Michael Gare, and Joseph Vermeulen. Carrie Small is a partner, and she leads the insurance tax practice of Baker Tilly, Virchow, and Kraus. Carrie joined the firm in 2010 and has significant experience with accounting for income taxes under ASC 740 and SSAP number 101. Mike Gare is a senior manager, and Joe Vermeulen is a manager and are also members of Baker Tilly's insurance tax practice. Both Mike and Joe work extensively with tax revisions for insurance organizations, including both privately held and public companies. Before we begin the presentation, I want everybody who's watching to know that these materials for this presentation will be available on our website, as will the video for this presentation. And now we'll hand it over to our presenters.
Thanks, Vaughn. As I'm sure everyone is aware of by this point, on December 22nd, 2017, President Trump did sign into law the Tax Cuts and Jobs Act. This represents the biggest tax overhaul since the 1986 Act. We do have a lot of material to cover today, some of which may still be unclear. So with that being said, the guidance that we are providing is preliminary, based on our current understanding of the indicated tax law provisions and our analysis to date. We do anticipate clarification of certain provisions through the future issuance of technical corrections, Treasury regulations, or other guidance. Ultimately, a bill that was passed that was meant to simplify the tax code has done anything but, and I think everyone will see based on our discussion today. We will focus today on the domestic provisions of the tax bill, as international implications can be the subject of an entirely separate webinar, as I'm sure anyone that has had to deal with those provisions, such as the BEAT tax, GILTI, the repatriation tax, would agree. Our agenda today, we will start by walking through some of the key provisions applicable to C corporations. Then we will talk through some of the key provisions applicable to both P&C and some life provisions. We will also go through some of the pass-through provisions that may be applicable to some of the associate members of PAMIC. We will talk high level through some fixed asset considerations and some planning opportunities there, and then go through some other key provisions that we think may be of some interest to insurance companies. And lastly, we will talk about the financial reporting considerations that all companies have to consider for the December 31st, 17 year end as a result of tax reform. So with that, we will talk through some key provisions for C corporations. The biggest item, which I think everyone is probably aware of, is that the tax rate for corporations did move from the 35% maximum rate down to a 21% corporate rate. As the bill was signed into law by Trump on December 22nd of 17, companies will have to remeasure their deferred tax assets and deferred tax liabilities for the financial reporting period ending December 31st, 2017. We will, as I mentioned, discuss the financial accounting aspects of the tax bill later on, but we do want to continuously stress that all companies will have an impact to their 2017 financial statements as a result of tax reform. Another key provision was a change in the rate for dividends received deduction. Under prior law, this deduction was equal to 70% of the dividends received, and the Tax Cuts and Jobs Act bill does reduce the 70% dividend received deduction down to 50%. And then for 20% owned corporations, it changed from 80% down to 65%. So the dividends received deduction is more of a 2018 event, which means that all of your tax calculations, such as your tax estimates, tax provision, tax return for 18, will have to be updated beginning January 1st of 2018. Moving on to the corporate alternative minimum tax. Under the tax bill, this alternative minimum tax was repealed, and that is effective 1/1 of 2018. So this does eliminate some of the complexities that we've had to work through in the past related to AMT, but we will still have to consider AMT impacts when we talk about admissibility, especially working through the first part of the admissibility test under 11A. The bill does allow the AMT credit carry forward to offset the corporation's regular tax liability for the taxable year, and the credit is now considered fully refundable. So there is a formula where you can take a certain percentage of your AMT credit every year as a refund, and if it's not used up by 2021, it does become fully refundable. There has been some discrepancy on the accounting for this, such as should you move the entire deferred tax asset to a receivable? Do you keep your AMT credit carry forward as a deferred tax asset, or do you move it as you expect to receive the cash? The FASB actually held a board meeting on January 10th where they discussed this matter, and they did express that they are fine with any presentation as long as it is applied consistently from period to period. They did note, however, that if you do move your AMT credit carry forward from a deferred to a receivable, that receivable should not be discounted. So for any companies that may have had a valuation allowance up against the AMT credit carry forward, this valuation allowance can now be released since the credit is fully refundable. So there have been significant changes to net operating losses in the treatment, the carry forward and carry back periods. In the past, generally, an NOL could be carried back 2 years and carried forward 20 years to offset taxable income. Under the new bill, generally there is no carryback period and there is an indefinite carry forward period. There is a change too, where even though you have an indefinite carry forward period, you are limited to 80% of your taxable income when you use that carry forward of the net operating loss. It's important to note though that this did not change for non-life insurance companies. So for all of the P&C companies, we still have the 2-year carryback and the 20-year carry forward similar to under the old law. And with this, we also do not have a limitation on the NOL deduction similar to other corporations. Life insurance companies, in the past, they had the 3-year carryback and the 15-year carry forward. They fall under the general provisions now where they have no carryback period and the indefinite carry forward period limited to the 80% of taxable income. A planning item here would be if you have carryback potential for losses arising in open tax years, if you are anticipating a loss in 2017, I would try to make that as large as possible if you have carryback potential, because you will be getting that deduction, that cash back at the 35% rate rather than the 21% rate. Another important item to note is that it's very important now to keep track of net operating losses and when they arose. For net operating losses that arise prior to years January 1st, 2018, those net operating losses can still be utilized against 100% of taxable income and will continue to have the old carryback provisions. So it is not until losses arising in the 18 tax year that you fall under these new carryback rules. It is also important to note that if you did a mechanical read of Section 172 in the bill, it does not differentiate between these pre and post 2017 losses. It appears as though the code wasn't drafted to actually reflect the transition that was intended. So as I mentioned in the beginning, there could be potential guidance, Treasury regulations coming out to clarify certain items. This would be one of them. Another item to note relating to the carryback and carry forward period for corporations other than our P&C companies, this could impact your valuation allowance assessments, because essentially going forward, you don't have 2 of the buckets for your future or your potential sources of income. So with the carryback carryback period going away, you would no longer have your carryback potential. And then tax planning strategies may have to be revisited because those were generally out there as a way to use expiring net operating loss carryforwards. And now that those loss carryforwards don't expire, you technically wouldn't have a tax planning strategy. We also want to note that the capital loss carryback and carryforward provisions have not changed. So we still do have the 3-year carryback and the 5-year carryforward for capital losses. 11A, therefore, is still applicable for life insurance companies going forward, so it is going to be on a much smaller scale as we're only looking at the capital piece and not the ordinary piece. Another item that we want to walk through with the bill change is the interest expense. There is now a deduction on interest expense, which we do not expect to have a significant impact to insurance organizations or other financial institutions, companies. And that is because it's generally limited to your business interest income and 30% of your adjusted taxable income. So it would be extremely rare for an insurance company to have more interest expense than interest income, which is why this provision is most likely not going to be applicable for insurance companies. But we did want to mention it just because it is one of the larger changes within the bill. So we just wanted to make everyone aware of that. There's also a change to the limitation on executive compensation under 162M. A covered employee does now include the CEO and CFO if the individuals hold those positions at any time during the taxable year, not just at year end. And it also includes the 3 most highly compensated officers for the taxable year other than those 2 individuals. Another change is that if the covered employee is a covered employee at any point after 16, they are always going to remain a covered employee. So it's very important to track this going forward, where you may have multiple covered employees, even if they're no longer employed by the corporation. The big change here, so 162M generally applies to public companies, and the deduction for executive compensation is limited to $1 million, and that did not include performance-based compensation in the past or commissions. That is the large change now under the tax bill, where performance-based compensation is no longer excluded from the deduction limitation. It does appear as though the limitation for health insurance organizations does remain at the $500,000 under 162M6. And then another item that we wanted to note was that there is a sentence in the joint explanatory statement which gives some clarification around the bill. And the sentence states that the proposed definition of publicly held corporations may include certain additional corporations that are not publicly traded, such as large private C corporations. There has been no further guidance or explanation around this, but we wanted to make everyone aware that there is potential in the future that there could be some clarification here. There's also a change related to taxable year of inclusion. This generally takes a look at any item of income that does not have a applicable code section and makes it includable under code section 451, but you can include it in income no later than the taxable year in which it is reported as revenue in the financial statements. As part of this, they do call out specifically special rules under Part 5 of Subchapter P, which includes OID, market discount, short-term obligations, discounts on short-term obligations, and generally those do have their own specific code sections, but under this provision they are excluded, so they have to follow the normal 451 or financial statement rules here. So generally what that would mean would be if you're in an insurance company that defers market discount accrual, you would no longer be able to defer that, and you would have to pick it up when it's reported as income in the financial statement. So any change here is treated similar to an accounting method change under Section 481, and it will be spread over 4 years. And then if it is a change related to OID, that does have a 6-year spread, and that would begin effective after December 31st, 2018. The main item to be concerned about here is if you do have a change in your method of accounting based on this special provision for the taxable year of inclusion, it does become more of a scheduling exercise when you're looking at your admissibility calculations or your valuation allowance calculations, because ultimately you would have a deferred tax liability set up for an item such as this on your financial statements. However, you may generally not have scheduled that out in the past or known the reversal period. However, under this rule, when you're changing from the old method to the new method, you know the timing of that reversal period. So if it's under the normal Section 41A rules, it's going to be spread over 4 years, but it would be a 6-year spread for OID. So Mike is going to walk us through some of the key provisions now applicable to P&C companies.
All right. Thanks, Carrie. So first off, we will start with the modification of the proration rules for tax-exempt interest and the dividends received deduction. The Tax Cut and Jobs Act increases the 15% permanent proration amount to 25%. This change is largely mechanical in nature, as the overall after-tax impact in the reduction to the deduction of the reserves still remains at 5.25%. So what I mean by this is that if you take the prior tax rate at 35% and multiply it by the prior 15% proration amount, then you get the 5.25%. Similarly, if you take the new tax rate times 21%, or the new tax rate of 21% times the new proration of 25%, you also get the 5.25%. So it's also important to note that a change like this is where we start to see the overlap in the old and the new tax regimes. So while working through the 2017 year-end tax provisions and your tax returns, you'll also want to be sure that you're updating any templates as you're for the new change as you're working through maybe Q1 2018 estimates or any 2018 modeling that you might be doing. Now we'll talk a little bit about the change to the discounting rules for loss reserves. Under the new law, the discounting rates to be used will be calculated based on a corporate bond yield curve using the preceding 60-month average of monthly yields on investment grade bonds as they are published by the Treasury Department. The new law also extended out the loss payment patterns for certain long tail lines of businesses for up to 24 years in some cases. And also we want to note that for short tail lines, there appears to be no change to the length of these payment patterns, remaining at 3 years. In terms of the overall application of how the new law will have an impact on reserves, it is generally expected that this new method for calculating the reserves is going to result in a higher discount rate used, which will create lower deductible tax reserves or higher taxable income. Also, as many of you know, under prior law, there was an election that taxpayers could make every 5 years to use their own historical loss payment patterns. This generally resulted in a larger deduction for the taxpayer than if it were to use the IRS's prescribed factors. In the case when a taxpayer would pay its claims faster than the industry average. Well, under the new law, this election has been repealed, so companies will no longer be able to use their own historical loss payment patterns beginning in 2018. This being said, though, there is an item to consider with respect to these loss payment patterns for companies that have been using this method to discount their reserves. So since 2017 is a determination year, and the election is still available for 17 to use your own historical loss payment patterns, it still might be worthwhile for the taxpayers to make this election and to discount their tax reserves using their company experience, as this would likely result in a larger reserve deduction, which you would be able to take into account the higher 35% tax rate. This could be especially beneficial when a company might have an overall tax loss in 2017, and there is carryback potential to prior years, resulting in recoupment of tax at the higher 35% tax rate. Also, there are transitional rules that you need to take into account for the change in the reserve calculations, as you will essentially need to recalculate your reserves as of 12/31/17 using the new tax law, and then also as of 12/31/17 with the old tax law. And any difference between these two is going to be spread over 8 years.
Mike, I want to jump in here and talk about something related to the accounting for this. Because the bill was signed into law December 22nd of 2017, you are effectively required to record the effects of tax reform within your 2017 financial statements. So what this means is it's more than just remeasuring your deferred tax assets and deferred tax liabilities at the lower tax rate. There are other things that we have to consider, and one of the main ones is with these transitional rule adjustments. So for example, if we say that we have stat reserves or GAAP reserves of 100, and under the old method of discounting for tax, we have tax reserves of 95. We would generally record a deferred tax asset of 5. If we were to take those stat reserves of 100 and recalculate them under the 18 bill, let's say we would have tax reserves of 90 since we're using a higher interest rate under the new bill. In that instance, we would essentially, when we're looking at our 2017 financial statements, we would be recording a deferred tax asset of 10 for the difference in the stat reserves of 100 and then the recalculated tax reserves of 90. And then we would have a corresponding deferred tax liability that we would set up for 5, which would account for that transitional rule adjustment that will be spread over the 8 years. So you essentially get to the same net impact on your financial statements, where in either situation we would have a net deferred tax asset of 5, but this is really a matter of grossing up our deferred tax assets for the impact of the transitional rules. So if this is important where we're looking at our gross deferred tax assets as part of our valuation allowance analysis or through our admissibility calculation. So I just wanted to make sure that everyone's aware that when we're looking at our 2017 financial statements, it is more than just an exercise of remeasuring our deferreds at the lower tax rate.
All right, thanks, Carrie. One last item related to this slide that we wanted to point out is that the new law does not specifically mention salvage and subrogation. So since the discounting of salvage and subrogation generally follows rules applicable to the unpaid losses, we do anticipate that the IRS will issue some type of guidance with respect to salvage and subro, that it will also be treated consistent with the new law. Next, we'll talk about special estimated tax payments. So for those taxpayers under Section 847 that have been using this method, you know that it's a bit of an involved and a complicated exercise that you've been going through each year. Well, the Tax Cut and Jobs Act repeals Section 847. So as a result of this, any balance existing in the special deductions account is included in income of the taxpayer for the first taxable year beginning after 2017. And then the amount of any existing special estimated tax payments are applied against the amount of the additional income inclusion. And then finally, any remaining special estimated tax payments that are left over are treated as estimated tax payments for the 2018 tax year and could result in a tax refund. Companies that have elected the special tax payment treatment should now consider whether or not they will have estimated tax payments attributable to the 2018 tax year and should consider the impact of this on the company's current receivable or their payable. All right. Now we'll talk about a few key provisions applicable to life insurance companies. We'll start off first with the small life insurance company deduction. This provision has been repealed. So the previous maximum deduction that could have been claimed by a life company that was taking this deduction of 1.8 million, well, that's no longer there. So the new law eliminates this special deduction for the segment of the life insurance industry where it was thought that the risk distribution benefits of risk pooling were the weakest. Because of the repeal of this deduction, we thought it was important to note that the 831B election does still exist for small insurance companies. The 831B election allows for small insurance companies to be taxed solely on investment income and not on underwriting income. And in order to qualify for this treatment, a company cannot exceed 2.3 million of net or direct written premiums for the 2018 tax year. This 2.3 million limit is a 100,000 increase from the 27 limit, as the increase is a result of the inflation index. The PATH Act that was signed into law by former President Obama and effective beginning with the 2017 tax year originally increased the premium limit and added the inflation index. It's also important to note that in order to qualify for the 831B, there are certain diversification requirements that need to be considered, specifically when there are insurance transactions between related parties. So even though the small life insurance company deduction is gone, you still maybe could benefit under the 831B if you are a small insurance company. With respect to the 10-year recognition period for a change in computing reserves, under prior law, if a life company changes method for how it computed its reserves, under 807F, then any income or loss resulting from that change would have been taken into account ratably over a 10-year period. Well, the Tax Cut and Jobs Act repeals this 10-year spread and treats this method change like all other accounting method changes, resulting in what we call a 481A adjustment, where any favorable adjustment is picked up in 1 year and any unfavorable adjustment is picked up into income over 4 years. The new law does seem to maintain that this method change is still an automatic change, and any prior 10-year spread in effect should continue to be included ratably over the remaining time period. With respect to the computation of insurance or life insurance tax reserves, the Tax Cut and Jobs Act states that the tax deductible life insurance reserves for contracts other than certain variable contracts would use the greater of the net surrender value of the contract or 92.81% of the reserve in determining the tax reserve amount. The new law also points out that, as it was under prior law, that the tax reserve may not exceed the annual statement reserves. The application of the new law is expected to lower the tax basis of the reserves, resulting in more taxable income and higher deferred tax assets. Similar to the non-life tax discounting that Carrie talked about a few slides ago, there is transitional rules that exist for the implementation of this provision as well. The difference in the tax reserves using the new law's discount factor recalculated at 12/31/17 versus the old law's discount factor at 12/31/17 is included in the taxable income ratably over an 8-year period as well, beginning in 2018. Now we'll talk a little bit about changes to deferred acquisition costs for life companies. Under prior law, certain specified policy acquisition costs were required to be capitalized and for the most part amortized over a 120-month period. As you can see in the slide, you will notice that the categories do remain the same. However, the new law increases the percentage for these categories. So quick math shows that the amount required to be capitalized for each category is essentially increased by 20%. Also, the new law changes the amortization period from 120 months to 180 months. But it's important to note that the new law does not change the special rule allowing for the 60-month amortization of the first $5 million of costs, still subject to a phase-out. Regarding the application for these changes, any existing unamortized amounts prior to the law change will be continued to be amortized over the remaining 10-year period, as the new law applies only to new premiums received beginning in 2018. That's a brief summary of a few key life insurance provisions. We're going to now go through a few key provisions for pass-throughs, which may be applicable to some of the associate members of PAMIC. who support the insurance members in various ways. So there's a deduction for certain pass-through income. This is going to apply if you're structured as an S Corp or a partnership, or even if you're a sole proprietor. So what the Tax Cut and Jobs Act does, it provides for a 20% deduction on the qualified business income, or QBI, for these types of businesses. The deduction is subject to income limitation and phase-outs, which we'll talk about briefly on the next slides. Qualified business income does not include wages or reasonable compensation, but rather the business income deemed essentially to be above and beyond wages or compensation. Note that income from what they're calling a specified service trade or business generally does not qualify for the deduction if the income exceeds certain thresholds. So what is a specified service trade or business? We do expect there to be more guidance released by the IRS on this one, but basically the new law states that a specified service trade or business are those where the principal asset is the reputation or skill of one or more of its employees or owners. So what does that mean? That could mean a wide variety of things. So we expect, like I mentioned, more to be released on what that exactly means, but the new law does specifically list a number of services that are considered a specified service trade or business: law firms, accounting firms, actuaries, consulting firms, and in general, the financial services industry. You notice that engineering and architecture businesses have been excluded from this specified service trade or business. So what does this all mean? Well, this 20% deduction, which is based on your qualified business income, is considered and taken on the individual's personal tax return, as the source of the qualified business income comes from the pass-through entity. The calculation is quite involved, so we will go through it very high level. First off, if you're not considered a specified service trade or business, you will be entitled to a deduction up to a max of 20% of your qualified business income. However, it is subject to a 50% wage limitation or a 25% wage and 2.5% capital limitation. Alternatively, if you are considered to be a specified service trade or business, you can still participate in the deduction if your individual taxable income threshold is less than $415,000 for married filing jointly and $207,500 for single filers. But note that this is also subject to the wage or the wage and capital limitation. So a specified service trade or business cannot participate in the deduction if married filing jointly income is greater than $415,000, but a non-specified service trade or business may benefit from the deduction if income is in excess of $415,000, as long as the taxpayer isn't subject to the two limitations that we briefly discussed and noted on the slides. The new law specifically with respect to this section did not simplify anything, so please consult with your tax advisor on how this specific provision might benefit you. And lastly here, we'll touch briefly on the S to C conversions. So the new lower corporate tax rate significantly reduced the advantages of being an S corporation versus a C corporation. Now there are many factors that one needs to consider before making a switch from an S to a C corporation. However, if you do make the conversion within 2 years of the enactment date of December 22nd, 2017, then there are two rules that you should be aware of. And so we'll just point these out here. First off, if there's a 41A adjustment as a result of the conversion, which this will most likely be as a result from going from the cash method to the accrual method, then this income pickup is taken into account over a 6-year period. And secondly, distributions that are made within 1 year after the conversion can be taken out tax-free to the extent that the S Corp had AAA. And after that 1 year period, distributions will come out pro rata between the AAA account and the accumulated earnings and profits account. And with that, Joe's going to take it over from here and go through some fixed asset considerations.
Hey, thanks, Mike. As we jump into fixed assets, the first slide here, I just want to point out that this is prior law. I want to point out that, as you can see from the chart, 2017 was supposed to be a 50% bonus depreciation, and then would slowly phase out after that over the next 2 years. And on the next slide, we have the current law. And if you look at the bottom of the chart, you can see that anything that was put into service after September 27th, 2017 through December 31st, 2022 will be allowed 100% bonus depreciation. And then after that, it will phase down by 20% over the next 4 years. If you look at the top of the chart, you'll see that it somewhat resembles, it's the old rules. And this is for assets that were purchased before September 27th, 2017, but put into service after September 27th, 2017. In that case, those assets are subject to the old rules. They have to take 50% and are not allowed the 100% bonus depreciation. Some other key items for bonus. The new rules did change the definition for a qualified bonus depreciation. In prior law, it had to be a new asset to the taxpayer. In the new rules, it can be a new or used asset. Also, for the first taxable years ending after September 27th, 2017, taxpayers can elect to still choose the 50% bonus instead of 100%, and they are also still allowed to elect on a class-by-class basis as in prior years. For Section 179, the expense limitation increased from $500,000 to $1 million. The cost threshold also increased by that amount. So if the total cost of the assets put into service this year exceeds $2.5 million, anything over 2.5 will start to reduce the 179 expense dollar for dollar. So essentially, if the total cost of the assets put into service this year was over 3.5 million, you are completely phased out of Section 179. The new rules also did change the definition for qualifying 179 property. Those include changes such as roofs or heating or security systems or HVAC systems. Those otherwise were not allowed under the old rules. Now, with bonus depreciation being at 100% and the benefit of Section 179 expensing, the result is ultimately the same, and it's pretty much a write-off, 100% write-off. But we want to remind you that when taking 179 expense, if you are at or near a loss position, a taxable loss, 179 cannot increase or create an NOL. However, there is no such limitation if you take bonus depreciation. We also want to point out that as a possible planning opportunity, if companies are at or near all the taxable loss for the year, and they also have carryback capability, and if they're able to take advantage of the 100% bonus depreciation to either increase or create their taxable loss, it might be beneficial to accelerate those deductions in order to carry back their loss when the tax rates were higher. Now we are moving on to some other key provisions. We are just going to touch on some of these. We're not going to go into a lot of detail, but we feel like they could impact a lot of companies, so we just wanted to bring them to everybody's attention. First are for research and development costs. In our experience, lately over the last year, we've seen a lot of companies start to redo their policy administrative system. And the potential change to this is that certain research and development costs will have to be capitalized and amortized over 5 years, whereas prior law, an election could be made to deduct those certain costs. But as far as the new rule goes, this does not take effect until after December 31st, 2021. So for those who are thinking about maybe redoing a policy admin system or some internal software, maybe more beneficial to do it sooner rather than later. Entertainment expenses. Entertainment will no longer be allowed to be deducted. So I'm sure a lot of people have lumped this into these certain expenses into a meals entertainment expense, and everything was 50% deductible in the past. But now we recommend that people start to break out the entertainment expenses separately, maybe track them in a separate account. The entertainment portion will no longer be deductible, but the meals part will still be 50% deductible. Also wanted to point out that for companies who have maybe a cafeteria in the building or on premises, that maybe subsidize some of the costs for the benefit of their employee, these costs also are now subject to the 50% limitation through December 31st, 2025. And then after that, these particular costs will no longer be deductible. Employee Achievement Awards. Not much new here. The new law did add a definition of tangible personal property for Employee Achievement Awards. So as a quick reminder, Employee Achievement Awards can be deductible by the company and not taxable to the employee as long as they meet the definitions of a tangible personal property. Some items that do not fall into that category are cash or cash equivalent items, checks or maybe cash, gift cards, coupons, certificates, anything of that nature will, in order to be deductible by the company, needs to be taxable to the employee. And lastly, there is a credit available in 2018 and 2019 for companies if the company pays at least 50% of the employee's wages while the employee is out on FMLA leave. Again, that is for 2018 and 19. And now I'm going to pass it back to Carrie to go over the last section.
All right, I'm sure everyone is pretty interested in this right now as they are working through their 2017 financial statements. Essentially, a lot of the information we walked through in this webinar today relates to 2018 changes that won't be in effect until next year. So as you're working through your current tax provision for your 2017 financial statements, that does continue to fall under the old bill or the old tax laws. So what does this mean right now for insurance companies as they are completing their 2017 financial statements? We had talked about how at the lower 21% corporate tax rate, you are required to remeasure your existing inventory of deferred tax assets and liabilities and remeasure those assets and liabilities at the lower tax rate as of the enactment date, which is December 22nd. So this remeasurement is applicable to all GAAP and statutory financial statements for the year ending December 31st, 2017. One item to note is for preparers of tax provisions that may have been familiar with this, if you have a return to provision adjustment that you're calculating and running through your 2017 provision now, there is going to be a discrepancy in the rates that you're using. So this is going to have an impact on the effective tax rate. So generally what that means is you're going to be calculating your current true-up at the 35% rate, but your deferred effect of that is going to be at the lower 21% rate. So if you are struggling with getting your effective tax rate to work, that is one item that you may want to take a look at and make sure it's running through correctly. There are some GAAP considerations that we want to discuss with you. Under ASC 740, GAAP does require deferred tax assets and liabilities to be measured at the enacted tax rate that's expected to apply when your temporary differences are realized or settled. As we highlighted a few times already, deferred taxes now have to be remeasured at this lower 21% tax rate at the enactment date. Under GAAP, all changes in the tax rate and tax law do run through your continuing operations. And this happens even when your rate change relates to deferred items that sit in other financial statement components, such as OCI. This ends up with a disproportionate or residual tax effect that's lodged within OCI. FASB did have a board meeting on January 10th where they discussed the issue of this residual tax effect, and they voted to add a narrow scope project related to this issue. Specifically, they were going to draft a proposed accounting standard related to tax effects that become stranded in OCI as a result of tax reform. They will be proposing to require reclassification from OCI to retain earnings, any stranded tax effects that are solely related to the newly enacted reduction in the corporate tax rate as part of the Tax Cuts and Jobs Act. This proposed effective date would be for fiscal years beginning after December 15th of 2018, but the exposure draft would also propose that early adoption may be permitted for financial statements that have not yet been issued. The exposure draft was released on January 18th and has a minimum 15-day comment period. Therefore, comments are due on February 2nd. So this means that we'll be looking at early February as a time frame for the final guidance related to this. Moving on to some statutory considerations. Stat 101 paragraph 8 states that changes attributable to changes in tax rates and changes in tax status should be recognized through surplus. And guidance has come out within the last few weeks that does state that this change in tax rate for statutory purposes should all go through your change in deferred income tax. So similar to the disproportionate tax effect that we just talked about for GAAP, we will have this, although it will just be within separate components of surplus. So when we're looking at recording our stat tax provision, we will have to run everything through our change in deferred taxes, even if it relates to an unrealized gain or loss. Some other considerations that we want to talk through related to admissibility is that going forward, starting with 18, 11A is no longer applicable for life insurance companies other than for capital purposes. So that is a change that you will have to take a look at next year for any life companies working through the admissibility calculation. 11B, when we're working through that this year for the 17 reporting year, we will have to look at our future projections of taxable income now at the lower 21% rate. So that is a calculation or template change that needs to be worked through currently. And then as we're looking at reversals under 11C, we have to consider the timing for those, especially if it's a result of a transitional adjustment, as we had talked about before, as part of the tax bill. One thing that you do want to pay particular attention to as you're calculating either your valuation allowance considerations or your admissibility test is that when we are looking at our carryback capability now at the end of 12/31/17, we will have a discrepancy in our rate. So our deferred tax assets are going to be recorded at a 21% rate, but for purposes of looking at the carryback, you can still carry back to the 35% rate. So it's important that we keep that in mind, make sure your template is updated for that, because I have seen a lot of templates where the 11A is looked at after the deferred tax assets or liabilities are already tax affected. So it's important to take a look at how those calculations are done, make sure that you're looking at your gross deferred tax assets and liabilities when you're looking at 11A to make sure you are taking advantage of the 35% carryback rate. It is also important to note that even though AMT is repealed with the new tax law, it still is applicable to carryback years prior to 2018. Therefore, when we are looking at our carryback potential under 11A, the AMT is still considered when working through those calculations. So we do highly recommend that companies spend extra time with their tax provision templates now or soon to make sure that all of the effects of tax reform are working properly. So as I mentioned, you want to look at 11A, make sure that you're accounting for the 35% rate in your carryback years, not the 21% rate. You'll want to make sure that your template is set up to account for the effect of the tax rate change on your deferreds, doing that remeasurement. And then you may also have to make changes in your effective tax rate calculation to account for the change in tax rate as a separate line item. So we want to make sure everyone's aware of this additional work, as I know everyone's going to be in a time crunch as we get closer to the end of February. Another item to note for statutory purposes is that on January 10th, the Statutory Accounting Principles Working Group did release a Form A related to the accounting for the tax effects of the tax bill within SAP 101. As part of the agenda item, the NAIC staff conducted an analysis of the deferred tax data that was reported in Note 9 of the 2016 statutory financial statements. And this was mainly as a result of concerns that the life insurance industry would be largely impacted with 11A being eliminated going forward, aside from the capital carryback provisions. From a review of the financial data that they did collect, they do not expect that the changes in the admissibility calculation will have a significant impact on the overall admittance of deferred tax assets. Therefore, they did not make a recommendation to revisit the existing SAP 101 guidance. They did, however, recommend minor revisions to areas within the guidance and the corresponding Q&A to change tax rates from 35% where indicated to the newly enacted corporate rate of 21%, as well as some other small clarifications such as that. They did also make a recommendation to do a more thorough review of the Q&A to ensure that the examples and other guidance contained within that is still relevant and applicable. So other current developments related to the accounting for tax reform. The SEC did provide guidance on December 22nd on the day the bill was enacted to account for the impacts of tax reform. And STAB 118, Staff Accounting Bulletin 118, generally provides relief to public companies accounting for the effects of tax reform. Through the guidance, it does put items into 3 different buckets. So the first one being that you're going to take a look at items that you can measure and account for within your 2017 financial statements. So an example of that would be remeasuring your deferred tax assets. You know that you have to remeasure it from the 35% rate down to the 21% rate, and you can effectively account for that currently. The second bucket would be items for which you may not have all the information that you need to account for the impacts of tax reform, but you can make a reasonable estimate. So if this is the case, you are required to record a provisional estimate, and then you have to true up the impact by the end of the measurement period, which is no more than 1 year from the enactment date. And if you do provide a provisional estimate, there are several disclosure items to be aware of that need to be included related to this estimate. The last bucket would include items for which you know you should be doing something related to tax reform, but you just don't have enough information at the time to make a reasonable estimate. So in this scenario, you do not have to record a provisional estimate, but you do have to include certain disclosure items. So this is very important, especially when we look at our transitional adjustments that Mike and I talked about related to reserves and other more temporary based items. So generally, if you cannot account for the tax reform impact on, say, looking at your reserves and remeasuring them at 2018 discount rates, if you can't make a reasonable estimate, you do not have to record the impact, but you do have to add additional footnote disclosure. So that was the SEC guidance I mentioned. The FASB did come out with a Q&A on whether or not private companies and not-for-profit entities can apply STAB 118, where they said that they would not object to private companies and not-for-profit entities applying the guidance under STAB 118, but if they choose to do so, that they should apply all of the relevant aspects in the STAB in its entirety, including the disclosure requirements. So FASB is in support of the guidance under STAB 118 as well. And then the NAIC did also come out recently talking through the impact of tax reform for the year in 2017. And consistent with STAB 118, they make mention that if there are any incomplete or uncertain components of the accounting for tax reform, that you can use a reasonable estimate when it is determinable. And you are supposed to make a good faith approach to whether or not you can record any provisional amounts in your 2017 financials. And if a reasonable estimate cannot be determined, you should just continue to apply the existing accounting guidance. The last thing that we wanted to touch on briefly was valuation allowances. So if you are a company that has a valuation allowance currently set up or a full valuation allowance, there are some additional considerations that you should be looking at when you're looking at your 17 statutory or GAAP financial statements. The first one being that if you have an AMT credit carry forward as part of your deferred inventory, and you have a valuation allowance set up against that, that can now be released since the AMT credit carry forward is now fully refundable under the tax law. As I mentioned before, when we're looking at the assessment of the valuation allowance, ASC 740 does identify 4 different sources of taxable income. So as we discussed briefly, the changes in the tax law may limit or get rid of 2 of these sources in future periods relating to NOLs and the tax planning strategies, no longer having carryback potential for all corporations other than P&C and health insurance companies. So that's something to consider. And then with the indefinite carry forward period for net operating losses for all corporations other than P&C and health companies, that also means that you may now have a deferred tax asset that can support the deferred tax liabilities that would revert, or deferred tax liabilities sitting out there that are indefinite lived, such as the indefinite lived intangibles. So there is potential that where if you had a full valuation allowance, but you had a indefinite lived intangible sitting out there, and that would put you in a net DTL position, it is possible that you could reverse that and pick up some income in your financial statements. And then lastly, you do want to consider the 80% limitation on the net operating loss usage going forward for companies other than our non-life, or so our P&C and our health insurance companies, as that will have to be looked at in more detail when you're looking through your valuation allowance calculation. So that completes our time for today. We want to thank you for joining us, and we hope that this was helpful in your understanding of the impacts of tax reform on your organization. If you do have any questions, please feel free to connect with us. Our information was on the slide in the beginning of the slide deck, so please feel free to reach out.
On behalf of PAMIC, I want to thank everyone for viewing our webinar. We hope that you found the presentation valuable. And again, I want to thank our Premium Gold sponsors for making events like this possible. We truly value their support of PAMIC and the mutual insurance industry. Baker Tilly is actually one of our Premium Gold sponsors, and we want to extend an extra special thank you to them for their presentation today. Great job, Carrie, Joe, and Michael. The presentation and slides from this webinar are going to be available on our PAMIC website. Thanks for watching.